Here's a mind-blowing fact. In 2018, the 25 wealthiest Americans saw their wealth grow by $401 billion. Want to know how much they paid in federal income taxes during that same period? $13.6 billion. That's a true tax rate of just 3.4%. Meanwhile, the median American household paid 14% of their income in federal taxes. Jeff Bezos, the world's richest man, paid zero federal income tax in 2007 and 2011. Elon Musk, zero in 2018. And here's the kicker. They didn't break a single law. Today, I'm going to show you exactly how the ultra-wealthy legally navigate a system designed to favor them. This isn't about tax evasion. It's about a financial game most of us don't even know exists. Let's pull back the curtain. The tax code favors ownership, not labor. Robert Kiyosaki, in his groundbreaking book Rich Dad, Poor Dad, explains a fundamental truth that changed everything for millions of readers. The rich don't work for money. They make their money work for them. But what does that actually mean in practice? The two-tiered tax system. Our tax code treats two Americans very differently. Let me give you a real example from United for a Fair Economy. Imagine a neurosurgeon who worked hard, broke through barriers, and now earns $400,000 per year from her salary. She'll pay a top marginal tax rate of 37% on that earned income. Now imagine a wealthy heir who spends his days on a yacht collecting $400,000 a year in investment income from his inherited wealth. He'll pay just 20% on those capital gains. Same income, half the tax rate. Why? Capital gains versus earned income. According to the Center on Budget and Progress Policies, this isn't a bug in the system, it's a feature. The tax code explicitly favors capital gains and dividend income over wages and salaries. Here's what French economist Thomas Piketty discovered in his landmark work, Capital in the 21st Century. When the rate of return on capital exceeds the rate of economic growth, wealth concentrates at the top, and our tax code accelerates this process. The top 0.01% of earners, those making an average of $35 million per year, receive over 44% of their income from capital gains. The typical American household earning $58,500, just 0.5% comes from capital gains. ProPublica's bombshell investigation revealed that Warren Buffett famously held on to his Berkshire Hathaway stock for decades, allowing his wealth to grow without triggering taxable income. Between 2014 and 2018, his wealth grew by $24.3 billion, but he paid just $23.7 million in taxes. That's a true tax rate of 0.1%. The corporate shield. Kiyosaki dedicated an entire chapter to the history of taxes and the power of corporations for good reason. The rich don't just own assets, they own them through corporations, trusts, and LLCs. Why? Because corporations can deduct business expenses before being taxed, pay themselves through capital gains instead of salaries, shield wealth from estate taxes, access tax breaks unavailable to individual wage earners. According to the Institute on Taxation and Economic Policy, 23 of the largest and most profitable companies in the U.S. paid zero federal corporate income taxes from 2018 to 2022. And their owners? They benefit from that same tax avoidance. The buy, borrow, die strategy. This three-word phrase, coined by USC law professor Ed McCaffrey in the 1990s, explains how billionaires access their wealth without paying taxes. ABC News called it legal tax avoidance on an epic scale. Let me break down exactly how it works. Step 1. Buy. The rich buy appreciating assets, stocks, real estate, businesses, art collections. Peter Thiel stuffed shares of what would become PayPal into a Roth IRA back in 1999 when they were valued at practically nothing. Today, that account is worth $5 billion, and it's completely tax-free. Step 2. Borrow. Here's where it gets brilliant. Instead of selling assets and paying capital gains taxes, the wealthy borrow against them. ProPublica found that borrowing isn't considered taxable income. A billionaire can take out a $100 million loan using their stock portfolio as collateral, live off that money, and pay single-digit interest rates, often lower than their assets' appreciation rate. Steve Cohen, the hedge fund billionaire and Mets owner, used this strategy extensively. So did Donald Sterling when he sold the Los Angeles Clippers for $2 billion. As one tax attorney told Tax Planning HQ, if you own a real estate asset that appreciates at 8% a year but can take a loan for 5% a year, you're coming ahead by taking the loan instead of selling. Step 3. Die. This is the brilliant finale. When the original owner dies, their heirs inherit the assets with what's called a stepped-up basis. This means the IRS resets the cost basis to the current market value, erasing all capital gains taxes. The heirs can then sell the assets tax-free, pay off the loans, and keep the rest. Or, better yet, they can start the cycle all over again. Buy, borrow, die. ProPublica discovered that more than half of America's 100 richest individuals use special trusts like grantor retained annuity trusts, or GRATs, to pass wealth to heirs while avoiding estate taxes. Michael Bloomberg, Charles Koch, and Laurene Powell Jobs, the widow of Steve Jobs, who publicly criticized legacy wealth building, all used these trusts. Powell Jobs avoided at least $200 million in estate taxes using this strategy. Real-world impact. At least 18 billionaires qualified for stimulus checks in 2020 because their reported income was below $150,000 for a married couple. Think about that. Billionaires receiving government assistance because on paper they had no income. Asset appreciation versus earned income. Let's talk about the wealth-building machine that most people never access, unrealized gains. According to economists Emmanuel Saez and Gabriel Zucman at UC Berkeley, U.S. billionaires hold about $2.7 trillion in unrealized gains, wealth that grows tax-free because it hasn't been sold. The working-class reality. For most Americans, this is how taxes work. Get a job, earn a paycheck, watch taxes get deducted before you even see the money, pay sales tax when you spend what's left, pay property tax on your home, and maybe, if you're lucky, save a little. That's it. Every dollar is tracked, taxed, and accounted for. The wealthy reality. For the ultra-rich, it's completely different. Own assets that appreciate, never sell, no taxable income, borrow against the growth, tax-free, deduct business expenses and interest, pass assets to heirs, stepped-up basis. ProPublica found that real estate mogul Jay Paul earned $354 million between 2007 and 2018, but paid taxes in only one of those years. How? Paper losses of over $700 million from real estate depreciation. Texas oil tycoon Trevor Reese Jones reported $1.4 billion in income from 2013 to 2018, but offset it with even greater losses. He paid zero federal income tax in 4 of those 6 years. The depreciation game. Here's something Kiyosaki emphasized in Rich Dad, Poor Dad. The tax code is designed to reward business owners and investors, not employees. Commercial real estate investors can take depreciation deductions on buildings that are actually increasing in value. They report losses to the IRS while their net worth skyrockets. Manhattan apartment towers soaring in value become tax write-off machines. A massively profitable natural gas pipeline generates Texas-sized deductions. Why financial literacy isn't taught in schools. Here's a question that should disturb you. Why don't schools teach any of this? The uncomfortable truth. According to the National Financial Educators Council, over 80% of Americans can't translate a basic tax form. 1 in 4 student loan borrowers is in default, yet only 23 states require personal finance education for high school graduation. Let me share what several researchers discovered. Financial journalist Dan Cadlick found that only 1 in 5 teachers feels qualified to teach a personal finance class. The system is too focused on standardized tests to make room for real-world money skills. But there's something deeper going on. The education to employee pipeline. Our education system, as Kiyosaki argued, was designed to create employees, not owners. Think about it.
Study hard. Get good grades. Find a secure job. Work for 40 years. Retire on a pension that barely exists anymore. This model worked for our grandparents' generation. It doesn't work today. Meanwhile, the wealthy teach their children completely different lessons: how to own businesses, how to use corporations for tax advantages, how to make assets work for them, how to leverage debt strategically, how to structure wealth to minimize taxes. According to Junior Achievement, 95% of teenagers say a personal finance class would be valuable, but the curriculum remains stuck in the 20th century, while the wealthy quietly pass down financial knowledge that compounds across generations. The consumerism connection. Some researchers, including financial advisor Cindy Kuyumjian, point to a darker possibility. Our consumer-driven economy benefits from financially illiterate workers who take on credit card debt, buy homes they can't afford, finance cars at high interest rates, never question the system. When you're drowning in debt and working paycheck to paycheck, you don't have time to build wealth or question the rules. The system runs deeper than you think. Let me tie this all together. The reinforcing cycle. Piketty's research, spanning 250 years, revealed a troubling pattern. Wealth inequality isn't self-correcting. Without intervention, it accelerates. When returns on capital exceed economic growth, the rich get richer not through superior skill, but through mathematical inevitability. The Brookings Institution found that high-income families face a top federal tax rate of 40.8% on their labor income, but just 23.8% on their investment income. And that's assuming they even report that income instead of using the buy, borrow, die strategy. What this means for you. You might be thinking this is unfair, and you're right, but anger without action changes nothing. Here's what Kiyosaki got right. The rules aren't going to change to help you. The wealthy write the rules. So your choice is simple. Complain about the system while remaining trapped in it, or learn the rules and start playing a different game. The path forward. You don't need to be a billionaire to start thinking like a billionaire. Understand the difference between assets and liabilities. Focus on building ownership, not just earning income. Learn about tax advantages available to business owners. Invest in assets that appreciate. Study the strategies the wealthy use. They're not secret, just not widely taught. The Brookings Institution, the Center on Budget and Policy Priorities, and ProPublica have documented all of this. The information is available. Most people just never look for it. In conclusion, the system isn't broken. It's working exactly as designed. It's just not designed for wage earners. It's designed for asset owners.
The 25 wealthiest Americans paid a 3.4% true tax rate, while the median household paid 14%. That's not a glitch, that's the game. But here's the thing. Once you see the game, you can't unsee it. And once you understand the rules, you can start playing differently. The question is, will you? If this video opened your eyes, hit that subscribe button. I'll be breaking down more wealth-building strategies they don't teach in school. Drop a comment. What shocked you most about how the wealthy game the system? And remember, financial literacy isn't about getting rich quick. It's about understanding the game that's been played all along. See you in the next one.